The Japanese yen has just crossed a historic line. By breaking above 162 against the US dollar, the yen has plunged to a fresh 40-year low. By the end of this video, you will understand why this level is a red zone for global stability and what the high-stakes game between the Ministry of Finance and the market means for your portfolio. So, why is this happening now? We're witnessing a fundamental disconnect. Despite repeated warnings from Japan's Ministry of Finance about excessive weakness, the market seems to be brushing off their concerns. This 40-year low isn't just a number, it represents a period of yen weakness not seen since the mid-1980s, putting the Bank of Japan in a challenging policy corner. Specifically, the US dollar to Japanese yen pair broke the 162.00 level with significant momentum. What's striking here is the market's lack of fear. Even as officials address the 40-year low, traders are laser-focused on the upcoming US non-farm payrolls data. If the US labor data remains robust, expect the Federal Reserve to stay hawkish, pushing the dollar even higher and leaving the yen vulnerable. On social media platforms like X, sentiment is reaching a fever pitch. Traders are openly asking, will we see government intervention soon, or is the yen heading straight to 200? The consensus suggests that the yen is currently the key funding currency for global trades. Its weakness signals carry trade dynamics that could snap back violently if authorities decide to step in. A critical report from Barron's has added a new layer of concern. Analysts warn that extreme yen weakness poses a direct risk to the US Treasury market. As Japan is a major holder of US debt, any sudden move to support the yen could lead to the selling of treasuries, potentially creating a cross-asset shockwave that impacts global interest rates and bond stability. For Japanese stocks, the impact is a double-edged sword. While yen weakness typically boosts exporters' earnings, the current extreme levels are creating funding currency stress. If a carry trade unwind occurs, it could trigger a broad sell-off in risk assets. Investors are keenly observing for signs that the yen's decline is shifting from a benefit to a structural risk for corporate stability. We can't overlook the global context. The upward pressure on US dollar to Japanese yen is reinforced by the Fed's hawkish stance. As we approach the non-farm payrolls release, any indication of a strong US economy gives the Fed more room to keep rates high. This widens the interest rate gap between the US and Japan, making it nearly impossible for the yen to recover without a significant policy shift or direct intervention. What should individual investors do? The key takeaway is to avoid chasing trends at these extreme levels. Intervention risks soar when sentiment is most one-sided. Pay close attention to official commentary from the Ministry of Finance and the volatility of the US 10-year yield. These indicators will signal a potential yen snapback that could catch many off guard. Our AI analysis suggests three likely paths. The base scenario predicts continued yen weakness toward 163 until the NFP release, followed by high volatility. In a bear scenario for the yen, a strong NFP and delayed intervention could test 165, sending shockwaves through global bond markets. Conversely, the bull scenario involves a massive MOF intervention that could quickly drive US dollar to Japanese yen back down to the 155 to 158 range if it sustains a move above 162.5. In summary, the 162 level is a historic breaking point that threatens US Treasury stability and signals extreme funding currency stress. Keep an eye out for intervention signals and US employment data this week. What is your target for the yen? Share your thoughts in the comments, and don't forget to subscribe for more deep dive insights into the Japanese market.